Hello, welcome to yet another episode of Let Us Talk. Hi, I am Himanshu Kapadia and I make your money work harder than you do. By education, I am a mechanical engineer and also completed my post-graduation in business administration. I am also qualified personal financial professional. I started my entrepreneur journey after 19 years of corporate experience. Now, after 19 years of an employee journey, shifting to employer journey is the best thing what I could do for my life and for sure for my clients. This shift after 19 years I could do very specifically because I had an instrument called mutual fund where I was investing my money very regularly, and that gave me a kind of a boost and a confidence by which I could think about sustaining myself for 3-4 years till the time my monthly cash flow starts coming in from my business, and I'm able to take this journey further, right? Nowadays, when people talk about mutual funds, it's very risky. I really get surprised. I'm not too sure why. But there are a lot of, I would say, inhibitions about mutual funds. Now, people say that is risky. It says if you invest money, the money can be lost. So basically, people perceive that as a risk. Now, my experience has been totally different, right? So, when you talk from a mutual fund is something where people like you and me invest money into the equity instruments or into debt instruments or gold or combination of all these things. So mutual fund is a very simple methodology by which the money is pooled, mutually collected, and basis on the intelligence of the fund manager, it is being invested into the markets. Now it can be equity markets where people will buy stocks. If it is a debt market, they will buy debt trading papers. Now, or if it is a combination of both, then it is hybrid funds, right? So mutual fund is a wide variety and choices where you would want to invest your money. And the biggest thing what I've seen in the mutual fund is it has its convenience of liquidity. It has a possibility of a partial or full redemptions. It has a possibility of a better tax efficiency. Over a long term, this mutual fund also gives us very tax efficient returns, which is not available in any other instruments. And that makes mutual fund for me the best of the choice for the investment instruments. Well, it is very simple. Many people believe that simple may not be effective, but I strongly believe if it is simple, then it will be effective. If mutual funds are effective and simple, then why it is being termed as risky? Okay, so let's try answering this. So 4 or 5 years back, the campaign always said mutual funds are subject to market risk. And that probably made people very skeptical about investing in mutual fund. According to me, when you talk about a risk comes from something which you don't know. You do something which you don't know, and that is what is the risk. Mutual funds are subject to market risk. 2. Mutual funds sahi hai. This journey is of conviction. This journey is of the data. This journey is of own experience, right? So, when we look at data from 1985 to 2022, the probability of you earning negative returns is 25% if it was invested for 1 year. That also means 75% of the time, even if it was invested for 1 year, you would earn a positive return. This drastically changes when your investment is for 3 years. Your probability increases to 89% positive. If it is 5 years, that goes to 90%. If it is 7 years, 10 years, this probability goes to 100%, right? So this data, the rolling returns of the Sensex which is shown, gives us a very specific confidence that over a long term, equity instruments are not risky. And when it is a mutual fund, it is backed by the research of the fund manager, right? Who day in, day out evaluates organization in which they would want to invest or they would want to move out, right? And that makes mutual fund really choice of the investment. Apart from the higher return, what mutual fund also offers is the tax efficiency. What it also offers is the liquidity. What it also offers is the partial liquidity where it is needed. So let me give you as an example, right? If you have a house of let's say 1 crore and you need 15 lakh rupees out of it, can you have it in 7 days time? I don't think so. It takes far more longer. The other part, if you wanted just a 15 lakh rupees of a 1 crore house, can you sell a bathroom? Not possible, right? Such kind of a liquidity and also the partial capital withdrawal is possible in this instrument, which really is class apart for any investor. Many investors are concerned about security of their money. Okay, so to know whether mutual funds are secured or not, let's look at the construct of the mutual fund, right? So mutual fund collects money from investors like you, me and many, that goes into the escrow account and deployed as per the mandate in either stocks, bond or combination of gold, stock, bonds, right? Now the money is either in the escrow account or it is in the market. Mutual fund companies known as asset management companies also can only withdraw their fees from the escrow account because it is under trusteeship, right? So SWP has appointed trusteeship and escrow account so that the money cannot be misused, right? But no mutual fund company can, get your money and run away with, right? In fact, if you go in details, you would come to know each and every paisa of the mutual fund, where it is deployed, how it is deployed, when was it deployed. Due to many reasons, our banks probably does not have this possibility to give you this information, right? Because they operate in a specific way with a limited usage of technology. But the mutual fund and SEBI regulated escrow accounts actually ensures that your money is safe and secured. There is also another reason why generally people are away from mutual fund, because of the jargons being used, right? At times it feels, no, what is it? I don't know, so I don't want to do it. So jargons generally are used are SIPs and SWPs and STPs. So let's try understanding what are these things, right? So these are all strategy, whether it's a SIP, SWP or STP, right? It's very simple. SIP is a system. This can be applied anywhere, but nowadays more used in mutual fund industries, right? So your bank account is debited every month on month with a specific amount, and being invested in specific mutual fund is known as SIP. This is a complete automated process. So it's a systematic investment plan, or planning is what you can consider this as a SIP. This is to inculcate the discipline in you. And trust me, this is what helped me to create my corpus and think about starting my own entrepreneurship journey. So this is about SIP. So simple, bank account debited, money goes into mutual funds as an investment. There's something called SWP, which is systematic withdrawal plan. This is used once the corpus is accumulated. So what is happening is, from a mutual fund on a specific date, the amount is deducted and goes into your bank account. Yes, this can be used for generating cash inflow for you, and it is generally utilized by people who are retiring or wants to retire early and use it in a way so that their monthly expenses are taken care of. So now, what is SWP? Systematic withdrawal plan. This is opposite of SIP. In SIP, amount is transferred from bank to mutual funds for the investments. In SWP, mutual fund is debited with a specific number of units to generate cash inflow for your bank account. SIP and SWP is used in combination. Okay, so when we are starting our journey in the investment, we generally start with SIP to ensure that sufficient corpus is created. So corpus can be created through SIP, that is a month-on-month investment, and SWP is something where once the corpus is created, you can have monthly withdrawal. We would always have a question, now where should we be investing? What kind of a funds we should use, right? So to understand this thing in a very basic way, so funds which invest directly in the stocks are equity funds. The stocks which invest in debt papers which are traded are known as debt funds, and the combination of equity and debt is known as balanced funds. Now in balanced funds, if they also have another asset class called gold, probably that's a hybrid funds, right? So equity, debt, balanced funds, these are the larger classification. So SIPs are done generally in equity funds to generate a higher return. So some people, or rather me, as my opinion, I would be doing SIPs in mid and small cap funds to have a rupee cost averaging advantage being on my side. I would use balanced funds for SWPs, right? So there my focus is keeping my money stable and withdrawing and growing with a bit more, or as a level of a market. Most of the senior citizens would want to invest their money into the fixed instruments like fixed deposits. Now the biggest challenge with that instrument is the inflation. So this may not be, so today's time when the FD rates are around 6 to 7% and inflation is also, let's say, 7 to 8%, you are finally reducing value of your money, correct? And here we can have SWP as a replacement of a portion of your corpus. To give you numbers, if you deploy 20 lakh rupees as a SWP requirement, you can withdraw 10,000 rupees a month. That makes a 1,20,000 rupees a year. That is a 6%. And in 10 years time, you would have already withdrew the corpus of a 12 lakh rupees. And now what happens to that 20 lakh rupees what we deployed? This is what the market instrument does. This is what the equity power does to your corpus. So 20 lakh rupees becomes almost 35 lakh rupees to 42 lakh rupees in 10 years time. even after withdrawal of your 12 lakh rupees, right? So this is where SWP is utilized. Nowadays, not only senior citizen, but many other people or even young people have started utilizing this instrument, like this money I have already done and I will have my vacation coming from this SWP as a yearly or a monthly withdrawal kind of a situation. Right, so this is the way we can utilize SWP, and which is the most needed in this hour. Right, when the inflation is on the rising side and our value of money is going down. So I am of the opinion that some portion must be deployed in SWP at whatever level possible, whenever possible, and you can start knocking off some of your committed expense, like maybe electricity bill, maybe your telephone bill, or maybe your yearly holiday expense or something of that sort. That can actually help you manage your money in a far more better way. I'm sure with some information what I provided takes you a bit closer to mutual funds than where we started from. Now, investment is all about making money available when in need. I am repeating, investment is all about making money available when needed, right? Otherwise, money does not have any purpose, right? So two purpose of money is what we understand. One is conserve and the other one is consume. You can do only these two things with money, right? My suggestion would be, invest money in such a way that you enjoy the utility of it as well. And liquidity and tax efficiency and inflation beating are the most important points while we do investing, right? I can work with you if you want and give you a lot of other information. You may please get in touch with us on highpacewealth.com, or my number is 89765 88888. You may please reach out to us or write it to me on himanshu@highpacewealth.com. Thank you very much.